The illusion of ownership. There's a company you've heard of, but you don't really understand it. It doesn't make cars, it doesn't sell phones, it doesn't drill oil, it doesn't run banks, it owns them, or more precisely, it owns pieces of all of them. And capitalism, ownership is control. This company manages more than $10 trillion in assets. That's larger than the GDP of every country except the United States and China. It is the largest shareholder in Apple, Microsoft, Amazon, Google, Meta, Nvidia, Tesla, JP Morgan, Bank of America, ExxonMobil, Pfizer, Johnson & Johnson, and nearly every other major corporation in the S&P 500. It owns between 6% and 8% of almost everything. Not majority control. Something more subtle, something more powerful. This company is BlackRock. And if you own stocks, if you have a 401k, if you hold an index fund, BlackRock votes your shares. Not you. You think you own stock. You don't. You own a claim. BlackRock owns the voting power. BlackRock decides who sits on corporate boards. BlackRock decides executive compensation. BlackRock influences mergers. BlackRock shapes corporate policy across the American economy. This isn't conspiracy theory, it's market structure. In 1988, BlackRock didn't exist. By 2024, it had become the most powerful financial institution in history. Not a bank, not a government, an asset manager. More powerful than Standard Oil ever was. More influential than JP Morgan's banking empire. Because those empires controlled industries. BlackRock controls ownership. And ownership is power. If one company owns significant stakes in every major corporation, if one AI system manages risk across trillions of dollars, if one CEO's annual letter shapes policy across the corporate world, you're not living in a free market. You're living in a system of concentrated financial power, an oligarchy, and BlackRock sits at the center. But to understand why this matters, you need to understand what BlackRock actually is. Most people think it's a bank. It's not. Banks take deposits. They make loans. BlackRock does neither. BlackRock is an asset manager. It manages money for pension funds, sovereign wealth funds, insurance companies, university endowments, governments, and millions of retail investors through ETFs. These institutions hand BlackRock their money. BlackRock invests it. And BlackRock charges a fee, usually small, sometimes 0.03%, sometimes 1-2%. It sounds insignificant until you apply it to $10 trillion. Now zoom out. BlackRock's risk management platform, Aladdin, oversees more than $21 trillion across the global financial system. That's not just BlackRock's money. That's money belonging to hundreds of other institutions who rely on BlackRock's software, one system, one platform, monitoring risk across 10% of the planet's financial assets. In 2020, the Federal Reserve hired BlackRock to buy corporate bonds and ETFs on its behalf. BlackRock became both player and referee, buying assets in markets where it was already the largest investor, deciding which sectors received liquidity, deciding which assets were stabilized. This wasn't illegal, it was efficient. And that's what makes it dangerous, because the system encourages it, rewards it, accelerates it. By 2026, passive index funds will likely control the majority of U.S. equity markets. Passive means no stock picking, no activism, no competitive capital allocation, just ownership of everything. And BlackRock is the largest passive investor on Earth. The more money flows into index funds, the larger BlackRock becomes. The larger BlackRock becomes, the more voting power it accumulates. The more voting power it accumulates, the more influence it exerts. The system compounds itself, quietly, legally, efficiently. So the real question isn't, is BlackRock powerful? It is. The real question is, what happens when ownership itself becomes centralized? What happens when competition is owned by the same shareholders? What happens when corporate governance is concentrated in one stewardship team? What happens when financial markets are guided by one risk engine? And what happens when the public doesn't even realize it? Because once you understand how this structure works, you can't unsee it. The 5 mechanisms of control, ownership architecture. BlackRock's power doesn't come from one thing. It comes from structure, 5 mechanisms, each legal, each documented, each reinforcing the others. Mechanism 1, concentrated common ownerships. BlackRock owns 6 to 8% of nearly every major corporation in America. Apple, Microsoft, JP Morgan, Exxon, Pfizer, Coca-Cola, Delta, not a majority. But enough to be the largest or second largest shareholder in almost all of them. And when you own stakes in all competitors, you don't care who wins. You win either way. Competition weakens, industry profits rise, consumers pay more. Mechanism 2, proxy voting control. If you own stock through an ETF or mutual fund, you don't vote. BlackRock does. It votes trillions of dollars worth of shares every year. Board seats, executive pay, mergers, corporate policy. In dispersed ownership structures, 7% is often the largest single voting block. That's not passive, that's decisive. Mechanism 3, Aladdin, the risk operating system. BlackRock's software platform analyzes over $21 trillion in assets globally. It models risk, recommends trades, guides allocation decisions for hundreds of institutions. If the same model sends the same signal, markets move. One system, one architecture, one set of assumptions shaping global capital flows. Mechanism 4, government integration. In 2020, the Federal Reserve hired BlackRock to purchase assets during crisis intervention. BlackRock bought corporate bond ETFs, including its own products. It was both executor and beneficiary. Add to that the revolving door between BlackRock executives and Treasury, the White House, and central banks. Policy and capital increasingly intersect. Mechanism 5, information dominance. Through Aladdin, direct holdings, and institutional relationships, BlackRock sees market flows before most participants do. Not insider trading. Systemic visibility. Data at scale becomes advantage, and advantage compounds. None of these mechanisms alone creates empire. Together, they do. Ownership, governance, risk infrastructure, policy influence, information scale. This is not a traditional monopoly. It's something more sophisticated, a monopoly of architecture. And architecture is harder to dismantle than industry. Why this is different from every monopoly before it. To understand how unprecedented this is, you have to compare it to history. Standard Oil controlled oil, 91% of refining at its peak. It owned pipelines, refineries, distribution. It set prices. It crushed competitors. It was obvious. And because it was obvious, it was broken up. J.P. Morgan controlled capital. Through interlocking directorates, his partners sat on the boards of railroads, steel companies, banks. His power was personal, direct, visible. And because it was visible, Congress responded. IG Farben controlled chemicals. It dominated a sector so completely it shaped national policy. It aligned industry with political power. And after the war, it was dismantled. Every great monopoly in history shared one trait. It controlled a single industry: oil, banking, chemicals, telecommunications. BlackRock is different. It doesn't control oil. It owns the oil companies. It doesn't control banks. It owns the banks. It doesn't produce pharmaceuticals. It owns the pharmaceutical companies. It doesn't run technology firms. It owns stakes in all of them. This is horizontal ownership across the entire economy, not vertical control of one sector. That distinction matters because antitrust law was written to stop dominance in one market. It was not written to stop minority stakes in every market. Owning 91% of oil is illegal. Owning 7% of everything is not. But 7% of everything can be more powerful than 91% of one thing. When you own competitors simultaneously, your incentive changes. You don't push one firm to destroy another. You encourage stability, predictability, higher industry-wide margins, less aggressive competition. This isn't monopoly through exclusion. It's monopoly through coordination. And it's invisible. There is no dramatic takeover, no single industry collapse, just gradual consolidation of influence, ownership without fingerprints, power without headlines. And because it's diversified, it's protected. When one sector falls, another rises. BlackRock doesn't bet on winners. It owns the game board. And the law has never confronted a monopoly structured like this, which means the structure keeps expanding. Quietly, legally, efficiently, and the longer it expands, the harder it becomes to reverse. The feedback loop that makes it unstoppable. The most important thing to understand is this: BlackRock's dominance is not static. It compounds, and the engine driving that compounding is passive investing. In 2000, active fund managers controlled almost everything. They picked stocks. They competed. They tried to beat the market. Index funds were small, niche. Today, more than half of U.S. equity assets are in passive vehicles. And that percentage keeps rising. Why? Because index funds are cheap. Because most active managers underperform. Because investors behave rationally at the individual level. If you can buy the S&P 500 for 0.03% instead of paying 1%, you choose 0.03%. That decision makes sense. But when millions of investors make that same decision, something else happens. Money flows automatically into the largest index providers: BlackRock, Vanguard, State Street. As money flows in, their ownership stakes increase. As ownership stakes increase, their voting power increases. As voting power increases, their influence over corporate behavior increases. And as influence increases, corporate profits stabilize. Less competition, more pricing discipline, higher margins. Higher margins mean higher stock prices. Higher stock prices attract more money into index funds, and the cycle repeats. It's a feedback loop. Capital flows, ownership concentration, governance influence, higher profits, rising markets, more capital flows. No conspiracy, no secret meetings. Just structural momentum. The more the system succeeds, the stronger it becomes. By 2030, passive funds could try to control 70% of U.S. equities. At that level, BlackRock and its peers won't need majority ownership to dominate governance. Collectively, they will have decisive influence everywhere. And here's the paradox. Passive investing was marketed as democratization, low fees, broad access, diversification. But passive capital creates centralized power. Millions of small investors, one voting authority. The crowd provides the money, BlackRock provides the control. And because this structure is efficient, regulators hesitate to interfere. Breaking it up would raise fees, raise costs, disturb markets. So the loop continues, not because it was designed to dominate, but because the incentives make domination inevitable. And once a feedback loop like this matures, it rarely reverses on its own. The circular ownership web. Now it gets deeper. BlackRock is publicly traded. Which raises an obvious question. Who owns BlackRock? The largest shareholder is Vanguard. Vanguard owns roughly 8% of BlackRock. The second largest is BlackRock itself through internal holdings. The third largest is State Street. Now, reverse the lens. Who owns Vanguard? Vanguard is technically owned by its fund holders. But Vanguard's largest holdings are in the same companies BlackRock invests in. And BlackRock is a major shareholder in those same firms. State Street follows the same pattern. BlackRock owns State Street funds. State Street owns BlackRock shares. Vanguard owns both. This is not conspiracy. It is structural circularity. 3 firms, owning each other, owning 20% of nearly every S&P 500 company collectively. Let's make it concrete. Vanguard owns 8% of BlackRock. BlackRock owns 7% of Apple. Vanguard owns 8% of Apple. State Street owns 4.5% of Apple. Now multiply that across banking, energy, pharma, tech, retail. The same 3 names appear everywhere. BlackRock, Vanguard, State Street. They don't collude, they don't need to. Their incentives align naturally because they own everything together. This is horizontal shareholding at scale. In the 20th century, monopoly meant one company dominating one market. In the 21st century, monopoly means a small cluster of asset managers owning minority stakes across every market. No single firm has majority control. Collectively, they influence everything. The structure is subtle. There is no headquarters controlling the economy. There is no single tyrant. There is a system of interlocking minority control. And because ownership is dispersed across funds, the public barely notices. But when the same 3 institutions vote 20% of corporate America, that's not fragmentation, that's concentration. It's not visible like Standard Oil. It's not dramatic like a trust. It's architecture. And architecture doesn't shout. It embeds itself, quietly, until it becomes the default structure of power. Aladdin, the financial operating system. Ownership is one layer of power. Risk is another. And this is where BlackRock becomes something no previous monopoly has ever been. It doesn't just own pieces of the market, it models the market. BlackRock's Aladdin platform, asset, liability, debt, and derivative investment network, manages more than $21 trillion in assets globally. That's not a typo. 21 trillion. Not just BlackRock's own 10 trillion, but pension funds, insurance companies, sovereign wealth funds, central banks, other asset managers. Hundreds of institutions plug into Aladdin. They use it to measure portfolio risk, to simulate stress scenarios, to calculate exposure, to decide what to buy, what to sell, what to hedge. Aladdin is not a spreadsheet. It is an ecosystem. It monitors interest rates, credit spreads, currency flows, equity correlations, geopolitical shocks. It runs millions of simulations daily, and when it flags risk, institutions respond. If Aladdin suggests reducing exposure to emerging market bonds, dozens of funds may sell simultaneously. If it signals opportunity in U.S. large cap equities, billions may flow in within days. This is not coordinated manipulation. It is synchronized modeling. But synchronized modeling moves markets just as effectively. Now consider the implications. In 2008, financial institutions relied on similar risk models. They underestimated housing risk. When housing fell, the models failed together. The system cascaded. Now imagine that instead of fragmented models across institutions, you have one dominant architecture guiding trillions. If Aladdin miscalculates risk, if its assumptions prove flawed, if it sends the same recommendation across hundreds of clients at once, market movements amplify, volatility compounds, systemic risk centralizes, and Aladdin is proprietary. Its algorithms are not public. Its modeling assumptions are not transparent. Institutions trust it because it works. Because it has worked for decades. Because it is sophisticated. But sophistication does not eliminate fragility. It can hide it. There's another layer. Information. Aladdin sees portfolio flows across institutions. It sees asset concentration. It sees exposure clustering. BlackRock insists on internal firewalls, separating Aladdin data from its own investment teams. And there is no public evidence of wrongdoing. But the asymmetry exists. Visibility itself is power. If you can see the tide forming before the wave breaks, you position differently. No government in history has had this level of systemic financial visibility. No private company has either. BlackRock is not merely participating in markets. Through Aladdin, it observes the bloodstream of global capital, and observation at scale becomes influence. Ownership gives control, data gives foresight. Combine the two. And you don't just invest in markets, you shape them. When government and capital converge, power becomes permanent when markets and government stop operating as separate spheres. And this is where BlackRock's position becomes uniquely consequential. In March 2020, markets were collapsing. Liquidity vanished. Corporate bond spreads exploded. The Federal Reserve needed to intervene. But the Fed doesn't directly purchase corporate bond ETFs in normal circumstances. So it outsourced execution. It hired BlackRock. BlackRock was tasked with purchasing corporate bonds and bond ETFs on behalf of the Federal Reserve, including ETFs that BlackRock itself managed. BlackRock was player and referee, executor and beneficiary. The justification was competence. BlackRock had infrastructure. BlackRock had Aladdin. BlackRock had scale. All true. But consider the structural implications. When crisis hits, the government turns to the largest asset manager to stabilize markets. When markets stabilize, the largest asset manager benefits. Its ETFs gain credibility. Its flows increase. Its influence expands. That is not corruption. That is structural reinforcement. Now widen the lens. BlackRock alumni occupy key government positions. Former executives move into treasury roles, advisory roles, economic policy teams. Former central bankers join BlackRock as advisors. Former treasury officials sit on BlackRock's board. This is the revolving door. Not dramatic, not illegal, common across industries. But when the largest asset manager participates in both capital allocation and policy formation, alignment deepens. Climate policy, financial regulation, infrastructure investment, sanctions frameworks, each decision intersects with portfolios worth trillions. BlackRock does not need to lobby aggressively. Its influence is embedded. When Larry Fink writes an annual letter to CEOs, markets read it. When Treasury drafts financial policy, BlackRock alumni often understand its mechanics intimately, and this creates convergence. Government relies on BlackRock for execution. BlackRock relies on government stability for asset growth. Now the two move in parallel, not as conspiracy, as system evolution. The line between regulator and regulated blurs. The distinction between private capital and public authority softens. And when crises occur, 2008, 2020, future shocks, scale wins. Governments choose the institution that can move trillions quickly. That institution is BlackRock. Every intervention reinforces its centrality. Every partnership normalizes its role. Over time, markets stop asking whether BlackRock should be involved. They assume it will be. And once assumption replaces scrutiny, power stabilizes. This is not the crude monopoly of railroads or oil. It is infrastructural power, embedded in liquidity, embedded in policy, embedded in crisis response. BlackRock doesn't need to control government. It simply needs to be indispensable to it. And increasingly it is. Who wins, who loses? Every structure creates incentives. Every incentive creates winners and losers. So who benefits from a world where BlackRock owns 7% of everything? First, BlackRock itself. Larry Fink built a machine that compounds. Assets flow in automatically through passive investing. Fees, even tiny ones, applied to trillions, generate billions. As markets rise, assets under management rise. As assets rise, fees rise. As fees rise, BlackRock's stock rises. It is a perfect flywheel. Second, large institutional investors, pension funds, endowments, sovereign wealth funds. They benefit from diversification and low fees. Index funds have delivered strong returns. On paper, the system works. But there's a hidden trade-off. Because investors gain in portfolios, while losing in pricing power as consumers. When common ownership reduces competition in airlines, banking, pharmaceuticals, prices rise, margins expand, shareholders benefit, consumers pay more. And since most people are both shareholders and consumers, the net effect is ambiguous. You gain in your 401k. You lose at the pharmacy. You gain in your ETF. You lose on airline tickets. The transfer is subtle, but measurable. Studies have shown common ownership correlates with higher airline ticket prices, higher banking fees, higher pharmaceutical costs, lower wage growth. Which brings us to workers. When the same shareholders own competing employers, incentives change. If BlackRock owns stakes in Walmart and Target, in Delta and United, in JP Morgan and Bank of America, why encourage aggressive wage competition? Why push companies to bid against each other for labor? Common ownership dampens rivalry, and dampened rivalry suppresses wage growth. Shareholders benefit. Labor absorbs the cost. Small businesses lose too. Competing against firms backed by trillions in institutional capital is not symmetrical. The giants have access to cheap capital, regulatory influence, scale advantages, entrepreneurship struggles, creative destruction slows, market concentration increases, and finally, democracy loses clarity. Corporate governance shifts from dispersed shareholders to centralized stewardship teams. Proxy voting concentrates. Policy influence aligns with institutional incentives. And the public rarely notices because nothing looks broken. Markets rise, index funds grow, retirement accounts appreciate. But beneath the surface, ownership consolidates, competition softens, influence centralizes, and power becomes less visible. BlackRock is not stealing. It is not violating law. It is optimizing within the system. The question is whether the system itself now optimizes for concentration. Because when capital ownership consolidates quietly, it rarely redistributes itself voluntarily. The future, acceleration toward concentration. The most dangerous phase of any structural shift is not its beginning. It's the moment when it becomes irreversible. BlackRock's rise has not plateaued. It is accelerating. Passive investing continues to gain share every year. Active managers continue to lose assets. Fees continue to compress. And rational investors continue choosing the lowest cost option, index funds. By 2030, passive vehicles could control 70% of U.S. equity assets. At that scale, ownership concentration reaches a tipping point. BlackRock, Vanguard, and State Street will not need majority stakes in any company. Collectively, they will command effective governance control across nearly all major corporations. And because they own everything simultaneously, competition continues to soften. Margins continue to stabilize. Volatility continues to compress, which makes index funds even more attractive. The loop tightens. Now extend this trajectory beyond public equities. BlackRock is expanding aggressively into private markets. Private equity, infrastructure, real estate, energy grids, water systems, ports, data centers. Assets once owned by governments are increasingly financed, operated, or influenced by institutional capital. If public markets saturate, private markets become the next frontier. The logic remains the same. Aggregate ownership, risk management through Aladdin, voting power where available, policy alignment where necessary. There is no natural stopping mechanism in this system. Regulation is unlikely to dismantle it quickly. Breaking up an oil monopoly is straightforward. Breaking up minority ownership across thousands of firms is structurally complex. Mandating pass-through voting rights to retail investors could dilute control. But retail investors rarely exercise voting power, and implementing such reform would require political momentum that currently does not exist. Meanwhile, technological integration deepens. Aladdin's modeling improves. Data becomes more granular. Artificial intelligence enhances predictive capability. The more markets digitize, the more valuable centralized risk infrastructure becomes, and BlackRock owns the dominant infrastructure. By 2034, if current trends persist, BlackRock could manage $20 trillion or more. At that point, it would not simply be the largest asset manager in history. It would be the largest allocator of capital in human history. More powerful than any empire, because empires control territory. BlackRock influences ownership, and in capitalism, ownership defines control. The future does not require conspiracy, it requires momentum. And the momentum favors consolidation, unless something interrupts it, unless political will shifts, unless investors consciously alter behavior. Otherwise, the trajectory is clear. Ownership becomes architecture. Architecture becomes system. System becomes default. And default becomes permanent. The quietest transformations are often the most enduring. And this one is still unfolding. The choice in front of you. BlackRock is not illegal. It is not secret. It is not operating outside the system. It is the system evolving. That's what makes it difficult to confront. There is no smoking gun, no dramatic takeover, no single villain. Just incentives compounding over time. Index funds lowered fees. Lower fees attracted capital. Capital increased ownership concentration. Ownership concentration increased influence. Influence reinforced stability. Stability attracted more capital. And here we are, a company that owns significant stakes in nearly everything. A company whose software models global risk. A company intertwined with government crisis response. A company that votes trillions of dollars in corporate governance decisions. BlackRock didn't overthrow capitalism, it optimized it. The question is whether optimized capitalism concentrates power faster than democracy can respond. You have 3 responses available. You can participate, own the index, benefit from the structure, ride the concentration wave. You can opt out, choose active strategies, direct ownership, diversification beyond the dominant asset managers. Or you can demand reform, pass-through voting, antitrust scrutiny of common ownership, transparency and proxy governance. None of these paths are simple. Each carries trade-offs. But ignoring the structure does not dissolve it. In 1988, BlackRock did not exist. By 2024, it managed $10 trillion. By the next decade, it could manage double. When ownership centralizes quietly, it rarely decentralizes voluntarily. The structure will continue expanding until friction appears. Political friction, market friction, public awareness. Now you understand the architecture, you understand the feedback loop. You understand the circular ownership web. You understand Aladdin. You understand the convergence of government and capital. And once you understand it, you can't unsee it. BlackRock, the company that owns everything, not through domination, through structure. And structure, once embedded, becomes reality.